Your credit score is like a report card for your finances. It shows lenders how well you handle your money, especially when it comes to borrowing and paying back what you owe. A good credit score can make it easier and cheaper for you to get loans and credit cards. It might even help you get lower rates on insurance. If you want to boost your credit score and improve your financial health, here's a simple guide to understanding everything about credit scores. Subscribe to the channel so we can get started. What is a credit score? A credit score is a simple three-digit number, typically ranging from 300 to 850, that helps lenders figure out how reliable you are when it comes to borrowing money and paying bills on time. This score is put together using information from your credit accounts, which is collected by credit reporting agencies or credit bureaus. The big three bureaus that gather and track this data are Equifax, Experian, and TransUnion. It's important to know that you don't just have one credit score. In fact, you have several, and they might be a bit different from each other. This happens because there are a couple of major companies that create these scores using their own methods and formulas. The highest score you can reach is 850, but achieving this perfect score isn't essential. That's because there isn't a huge difference between having a perfect score and simply having an excellent score regarding the benefits you can get, like lower interest rates and better loan terms. While it's great to aim high, don't worry too much about hitting 850. Credit scores also tend to change often, so a perfect score today might be slightly lower tomorrow due to normal fluctuations in your financial activities. Why lenders use credit scores? When you apply for a loan or a credit card, lenders look at your credit score to decide if you can be trusted to pay back your borrowed money. But that's not all they look at. Along with your credit score, they also consider your income, how much debt you already have, and other parts of your credit history. This helps them figure out if you qualify for the loan or card and what your borrowing costs will be, including your interest rate and any fees. Credit scores are really useful for lenders because they give a quick snapshot of your financial behavior. A good score suggests that you're likely to pay back what you borrow on time. Because of this, lenders often set a minimum credit score you need to reach before you can be considered for a loan or credit card. If your score is above this minimum, the lender will examine your financial situation more closely to decide on your application and work out the details of your loan terms. What affects your credit scores? Understanding what affects your credit score is like learning the rules of a game. The higher you score, the better your chances of winning good financial deals. Here's a simple breakdown of what factors into your credit score. Payment history. This is a big one. Whether or not you pay your bills on time affects your credit score. Missing a payment can hurt your score, while paying on time can help maintain or improve it. Amounts owed. This looks at how much you currently owe compared to your total credit limit, known as your credit utilization ratio. Using too much of your available credit can signal to lenders that you're overextended and may have trouble paying back new loans. Length of credit history. How long you've had credit also matters. A longer credit history can be beneficial because it gives more information about how you've managed credit over time. Types of credit used. It's good to have a mix of different types of credit, like credit cards, a car loan, or a mortgage. This shows lenders you can handle various types of credit responsibly. New credit. Every time you apply for new credit, it can cause a small temporary drop in your score. This is why it's important to not apply for too much new credit all at once. All these factors are combined to determine your credit score, which can then be used by lenders to decide if they think you'll be a responsible borrower. FICO score versus Vantage score. When it comes to checking your credit score, you might come across two different types, FICO score and Vantage score. Both are used by lenders to assess how risky it might be to lend you money. But they have some differences. FICO score has been around since 1989 and is the most well-known type of credit score. Most lenders use FICO scores to make their decisions. This score ranges from 300 to 850, and it looks at your payment history, amounts owed, length of credit history, new credit, and types of credit used. Vantage score is a newer model developed by the three major credit bureaus, Experian, Equifax, and TransUnion. It was introduced in 2006 as an alternative to FICO. Vantage score also uses a range from 300 to 850, but it calculates your score a bit differently. It considers similar factors, but places different weights on them, and might score some parts of your financial behavior more or less severely. One key difference is that Vantage score might give a score to someone with a shorter credit history more quickly than FICO would. This can be helpful if you're new to using credit and don't have a long credit history yet. Both scores are valuable, but since different lenders may use different scoring models, your score might vary from one lender to another. It's a good idea to check both your FICO score and your Vantage score to have a complete picture of where you stand. This way, you can better understand how potential lenders might view your creditworthiness. Why is having a good credit score important? Having a good credit score is like having a golden ticket in the world of money. Here's why it's so important. 1. Getting approved for loans and credit cards. When you want to borrow money, like for a car or a house, lenders check your credit score to see if you're a safe bet. A good score makes it more likely that they'll say yes to lending you money. The same goes for getting approved for credit cards. 2. Better interest rates. If you have a good credit score, lenders see you as less risky, so they might offer you lower interest rates on loans and credit cards. This can save you a lot of money in the long run because you'll pay less interest over time. 3. Renting an apartment or house. Some landlords check credit scores before renting out their place. A good score can make you a more attractive tenant because it shows that you're responsible with money. 4. Getting utility services. When you move into a new place, utility companies might check your credit score before hooking up services like electricity, water, or internet. A good score can make it easier to get these services without having to pay a big deposit up front. 5. Lower insurance premiums. Believe it or not, some insurance companies use credit scores to help determine how much you'll pay for things like car insurance. A good credit score might mean lower premiums, which can save you money each month. In short, having a good credit score opens up lots of doors and can save you money in many areas of your life. So it's worth keeping an eye on your score and doing what you can to keep it healthy. How to improve your credit scores. Improving your credit scores is like giving your financial health a boost. Here are some simple steps you can take. 1. Pay your bills on time. One of the biggest factors in your credit scores is your payment history, so make sure you pay all your bills on time every time. Setting up automatic payments or reminders can help you stay on track. 2. Keep your credit card balances low. Using too much of your available credit can hurt your scores. Try to keep your credit card balances below 30% of your credit limit. Paying off your balances in full each month is even better. 3. Don't close old credit card accounts. Closing old credit card accounts can actually hurt your scores. It's better to keep them open, even if you're not using them much, because they can help boost the length of your credit history. 4. Only apply for credit when you need it. Every time you apply for credit, it can ding your scores a little bit, so only apply for new credit when you really need it. 5. Check your credit reports regularly. Mistakes in your credit reports can drag down your scores. That's why it's important to check your reports from all 3 major credit bureaus, Equifax, Experian, and TransUnion, regularly. If you spot any errors, be sure to dispute them right away. So these are important things to know about your credit score. If you like this video, hit the like button and subscribe to the channel.